Semiconductor stocks are sliding again, and all eyes are turning to one number that could decide what happens next. US technology futures edged lower in early trading, led by chip stocks extending a recent pullback. Futures tied to the Nasdaq composite felt the pressure, and with good reason. Technology companies make up a large share of that index, so when semiconductors slide, the Nasdaq tends to follow. This isn't random noise. Chip stocks were among the biggest winners of the artificial intelligence investment boom. That run-up pushed valuations, essentially what investors are willing to pay for $1 of future earnings, to very high levels. And high-valued stocks are the first to get hit when the outlook shifts. Right now, the outlook is uncertain, and investors are being cautious. The reason for that caution lands Friday morning, the US non-farm payrolls report. This is one of the most closely watched economic releases of any month. It tells us how many jobs employers added or cut, what happened to the unemployment rate, and whether wages are rising or falling. Those three numbers feed directly into how the Federal Reserve thinks about interest rates, and how the Fed moves on rates shapes the entire market. Here is the tension investors are sitting with right now. A strong jobs report, say employers added more workers than expected, could push bond yields higher. That happens because a strong labor market signals the Fed may not need to cut rates anytime soon. When yields rise, future corporate profits look less valuable in today's dollars. That weighs on growth stocks, including technology. A weaker than expected report flips the script, but not cleanly. Soft jobs data could raise hopes for earlier Fed rate cuts, which would normally support tech stocks. But it could also stoke fears that the economy is slowing faster than expected. That kind of mixed signal tends to produce choppy, directionless trading rather than a clear move in either direction. Analysts broadly expect the labor market to stay resilient, but recent data has shown some softening at the edges. Not enough to alarm, but enough to watch. Wage growth is one number to track closely. If wages are rising quickly, that keeps inflation pressure alive and keeps the Fed cautious. If wage growth is cooling, it gives the Fed more room to act. The bottom line, today's jobs report will set the tone for rate expectations over the coming weeks. For the technology sector specifically, it could determine whether this slide deepens or finds a floor. Watch the payrolls headline, but pay just as close attention to wages. That is the number the Fed will be focused on. This briefing is brought to you by First Financial News. Clear daily coverage of the economy and markets at firstfinancialnews.com.